All right, today we're gonna be talking about one of the subjects that are becoming so much more popular in today's real estate market, and that's how to finance short-term rentals or STRs. Hey, what's going on? I'm Andy Garretson. I teach people what they didn't learn in school about how to buy their first home and invest in real estate. And today we're talking all about short-term rentals and how to get loans for these types of properties. I'm a mortgage lender here in Nashville. I'm currently standing at The Lucy, which is a short-term rental townhome community in East Nashville. It's currently off market, but it's gonna be listed here coming up in the next couple weeks. And so I want to talk today about how does a buyer who wants to invest in short-term rentals actually get financing for a unit like this. So as a mortgage lender, there's really two products that are going to fit for this type of housing. And when I say this type of housing, I'm really talking about the use for the investment. So in this case, it's a short-term rental. These are townhomes. And so when you go to buy a typical townhome, you have a couple options available. The first option that's always gonna be the number one go-to when it comes to getting financing on a home is gonna be conventional financing. So in the mortgage world, that means if it's conventional financing, it means it's conforming to Fannie Mae and Freddie Mac, the people who write the rules for mortgages. So a conventional loan for an investment property like this is gonna require at least 20 to 25% down, depending on the property. And this is gonna be a typical underwriting process that involves submitting your income documentation, your credit report, your assets. You're probably gonna need to show the lender that you have reserves. This is just like any other underwriting that a typical home buyer would go through. So does your credit score qualify? Typically you wanna have a credit score of at least 680 for a loan like this. The income documentation, if you're self-employed or you have other rental properties, you're gonna be submitting all of your tax information, all your tax returns, possibly some profit and loss statements. And then if you're employed or you're a W-2 worker, you're gonna be submitting your pay stubs, W-2s, and information like that for the lenders to underwrite. The last piece is the down payment. So the assets that are needed to get a conventional loan on a short-term rental property like this, like I said, are gonna be either 20 to 25% down, typically 2 to 4 months of reserves. If you own other properties, the underwriter is going to want to see that you have more money in the bank. A reserve is just 1 month's worth of payments on your mortgages and the expenses on those properties. So if you have 2 months of reserves, that means if all of your payments are 10 grand a month, that means you got 20 grand in the bank. That's 2 months reserve. So something to note when getting financing for a unit like this, gotta have the credit, gotta have the income, and you gotta have the assets to show that you have something in the bank. So the second option that we're gonna talk about today when getting a mortgage for a short-term rental is called a debt service coverage ratio loan. That's a long title, but condensed, it's DSCR. A DSCR loan is a little bit different than conventional financing, which we already talked about. Debt service coverage ratio is a way that the loan is underwritten that approves the borrower's ability to get a loan on a property like this. So what is DSCR? Well, instead of using conventional underwriting when it comes to income, they only underwrite the property itself and how much cash flow and how much rental income the property is bringing in. For example, if a property like this at The Lucy here in Nashville brings in $6,000 a month, the bank on a DSCR loan will count 75% of that $6,000 a month toward the underwriting cash flow. So if a property like this at The Lucy brings in about $6,000 a month in short-term rental income, averaged over 12 months, well, that $6,000, the bank will take $6,000, factor it by 75%. So 75% of $6,000 is $4,500 a month. And they say as long as the monthly payment on the new loan is less than $4,500 a month, they will qualify and approve a loan for one of these units. So again, it's all about how much rental income does each of these units bring in, and does that cover 75%? Does that cover what the new monthly mortgage payment is going to be for the loan? Now, I didn't talk about credit yet, but credit is also important because credit is also a factor in this type of mortgage, and a typical credit score is going to need to be over about 660, 680 really, and these are going to require, again, at least 25 to 30% down, depending on credit score and other factors. The last piece is assets. So what type of assets do you need to get a DSCR loan? Well, the lender wants to see at least 2 months of reserves for the payment that you're going to be making on the new loan. So again, if that payment is $4,000 a month, the lender wants to see 2 months of reserves, which is $8,000 in a bank account in the borrower's name. So a couple more things about the DSCR loan that make it a very, very attractive type of loan for investors. First thing is, you can close in the name of the borrower, or you can close the financing in the name of an LLC. So this is very unique when it comes to residential mortgage lending, because most of the time you have to get the financing in the personal name. It's personally guaranteed and it's on the personal credit report of that investor. However, a DSCR loan is eligible to be lent to a LLC that is majority owned by that borrower. So at least 51% or more ownership from the borrower, is that LLC is eligible to have the financing be secured by it. Now, why this is important is because the next time that investor wants to buy a property, DSCR loan that's tied to the business is not going to show up on personal credit. So it's not going to be on the personal credit report. However, the DSCR loan is going to be personally guaranteed and your credit score will be considered. However, the next time that investor goes to buy a property, his personal credit report is not going to show that DSCR loan because it was lent to the business, the LLC, not the personal name. So another huge benefit to a DSCR loan is that it doesn't matter if it's long-term income, short-term rental income, or mid-term rental income. You can use pretty much any type of rental income on a property as long as you have a history of it on the application. So it's very versatile in what type of income it allows on the application. So when thinking about the income that a property receives, if it's a long-term rental, if that property is already rented out and a tenant is currently in the property, it's pretty simple. You just use whatever lease is in place to qualify for the new loan, okay? So that's long-term. If it's not rented out currently, then you would order an appraisal, and the appraiser would look at other rental properties in the area that are comparable to your property that you want to buy, the subject property, and they would determine the fair market rent that you can collect projected on that property. So that's how you would determine what you qualify for in that case. When it comes to short-term rentals, if you're buying a property that is a brand new short-term rental, you haven't rented out yet, maybe it was just built by a developer, how you determine what that average income is going to be off of that property is you go to a website. AirDNA is the data warehouse for Airbnb and other short-term rental, vacation rental companies, and it collects all the data. And pretty much how it works is you punch in any address in the US and it will tell you, based on how many bedrooms and bathrooms and how many guests can stay in that property as a vacation rental, what the projected annual income will be. So AirDNA, if you go to that website, you can play around with it and start testing out what the incomes are based on different areas of the country. So that's actually how us as the lender determines what type of income we can use off that property. Again, we only use 75% of whatever the projected income is, but on a short-term rental, that's how it's determined. Now, if the property has already been rented out, or this is a refinance transaction, meaning you already own it and you're just refinancing a loan and it's been a short-term rental previously, you just go back and look at the last 12 months of rents and you collect all the history, and whatever you rented it out for the last 12 months is used as income on the application. So there's kind of two ways to calculate the income for this type of property.